Welcome everyone. I'll let everyone come in on the session. So I can see everyone coming in now. I think I'll just give everyone another few minutes, just another minute or two, and then I'll get going. Sorry for the delay for those that thought it was last week. I had to reschedule. I've got my voice back. It's still not 100%, but I had lost my voice a few days last week and could not speak at all. So had to delay the session for a bit. So we will be recording it today. So what I'm aiming to do through this 4-part series, we get a lot of questions from clients. I mean, running a small business is hard enough as it is. Employing people is even harder. And then as a small business owner, one of the many 10 hats that you're wearing, you're expected to be the expert in everything related to employees and payroll and everything like that. So I wanted to go through and bring everything into one spot, because I know when you actually go to look at different things for your employees, you're actually going to the Business Victoria website, Fair Work Australia, the ATO, State Revenue Office, and all these different places. And so what I wanted to do is bring all of these different areas, many questions that we get from our clients, and bring it all into one spot. We've got an employer hub on our website now, where we're trying to bring all of those parts together. And then on top of that, have this webinar so that I can go through these various different aspects. And then as you have questions, feel free to ask or even send some more details through if you want other topics covered. So for those that don't know me, I think I know about half of you on the call. And for those that I don't know, thanks for joining us today. So my name's Shannon Smith. I'm the founding director of Smart Business Solutions, set up the practice just over 17 years ago. Now we've got just over 20-something staff, and we do financial planning, accounting and tax, and mortgage broking. So we try and be a one-stop shop for our clients, anything financial, if we can help you with that. That's what we're trying to look at as well. So what I want to go through today, and I've done it as a 4-part series, otherwise we'd spend a whole half day or more on this. And I've broken it up into various different areas, and I've started with some of what would be, I think, some of the high focus areas that I'm seeing at the moment from clients, but also from the tax authorities or the various authorities going after clients. So I want to go through today employee versus contractor and understanding the difference. And this is not just for those that are on the call who are tradies. Let me give you an example of what I've actually seen come up in related to marketing services and admin services with situations that have come up as well. I want to talk a bit about PAYG withholding, and something that we often think, oh, our computer's just doing it all. Maybe we don't need to worry too much. Foreign employees is one that we're definitely seeing a lot more questions coming our way in relation to that, especially after some of the law changes in the last few years. Long service leave, work cover, and the worst of all taxes, payroll tax. Next week, we'll have other topics that we're going to cover as well. So I've just kind of broken it up over the 4 sessions. The last session, I'm also going to have a specialist employment lawyer as well to talk about some of the changes that are coming up as well. So I am starting with the employee versus contractor, because this is one that is burning so many small businesses, and it's not just about those in the trades. A lot of those in the trades are the ones that are being stung by this situation, but it's not just those in the trades. We have actually seen it with a new client that came to us, and they had it with their marketing consultant who had been working a few days a week with them and other people. And, obviously, usually a lot of these employee versus contractor issue usually comes up when there's a dispute between the two parties. And then all of a sudden, that contractor that didn't want to be an employee, all of a sudden wants to be an employee and claim super. I even saw this more recently with someone from a marketing perspective, but the pain and suffering they had to go through, not only with the person, but through Fair Work Australia, the legal costs that were associated, and nothing was documented. So I thought this was a really topical one to start with, because I am seeing a lot of situations. So why does this matter? We actually have seen over the last few years probably more and more use of contract labour. people have, gone out on their own and then are subcontracting to various different parties. There's a lot of activity from an ATO perspective, and even also the State Revenue Office perspective, because they want a piece of the action. If you've now got a contractor that's technically an employee, then they want a bit of the action from a payroll tax perspective. There's the liabilities can actually accumulate really quickly because of the penalties, not only for the taxes or the super that hasn't been paid, but also on top of that, some of the penalties as well. And then the other risk is the potential director penalties, because as of a few years ago, as directors of the company, you are now then personally liable for any of these taxes if you do not lodge on time and then pay on time as well. So the penalties can get quite significant. And then also reputational damage. I mean, how many of these have we seen in the newspapers at the moment with some of the bigger companies? And, none of us really want to go down those. So this was really one that I wanted to start with first, because there's been a lot of court cases recently on it. And the ATO is so confused by it as well that they have actually pulled from their website the employee contractor tool, the decision-making tool that, small business owners and contractors and employees could go through themselves to see where they land. The ATO's actually pulled that for the moment. They're trying to relook at it. So that tells you a bit of the grey and the confusion that's going on around that. So let's step back to what do we mean by a definition of an employee. So when we're looking at the definition, and they kind of go back to the defining what is an employee in kind of common law definition. Now, I'm not going to bore you with all the legal aspects, and more of this webinar, I'm going to focus on, well, what can you do, what can you control, and how can you help yourself? But that's what's going to happen in a situation is, under the normal common law definition, are they an employee? And if they are, yes, they should have had superannuation guarantee, and they should have had PAYG tax withholding. Directors entitled to a payment, yeah, they should have. And that's why any of you that maybe we do a director's fee at the end of the year, you'll notice that we actually have to put super on that and PAYG. There's then other special rules, members of parliament, artists and sports musicians. And then there's the contract wholly or principally for labour. So these are the 5 key, areas when they look at definitions with employees. And then the contracts where you're contracting someone wholly or principally for their labour and not necessarily maybe equipment that they bring to the table, that is where you're more likely to have an employee relationship than that of a contractor relationship. So let's have a look at some of the indicators. Now, some of these indicators, and these are really worth going through, and I can probably put them as a list and some checklists on them. These indicators are really worth going through with the particular contractor that you maybe have, because when you're dealing with someone and they say, oh, look, I can contract for you, and then you say, well, are you a contractor or an employer? I need to make sure, because as a business owner, you're more at risk than they are, because if they're a contractor, they're going to negotiate with you. I want to get paid $70 an hour, and I will put that through my company and trust, and I'll touch a bit on the entities a bit later, or you'll pay me directly and I'll deal with my own taxes, and you don't need to do super because I'm a contractor to you. And then when a dispute arises, and then there's another one, it's actually not a client of mine, a friend of a friend that has it. So I'm not going to have anyone on here that gets offended that it's their situation. But they're in the trades, and they've had someone that's worked for them for like 20-something years as a contractor all this time, and there's a bit of a dispute happened, and now they're going them at Fair Work on saying that they were actually an employee. They worked the same amount of hours every week. Tools were provided by the employer, and they now want super for all that period of time. The unfortunate thing is, I bet you they're going to be successful in this actual situation because they can prove a lot of these different factors. So what you're looking at when you look at, are they a contractor and employee, knowing that the contractor is going to want to say they're a contractor. And I'll touch on later, can you contract out of that situation? So what you want to look at is, well, what's with the control? So is the individual being remunerated wholly and principally, they call it, for their personal labour and skills? Must they work the perform the work personally, i.e. they can't delegate it. And maybe many of you, when you get a contract with one of your clients, you may have a team of people and you can delegate it to those people and you can deliver an ultimate result and you're in control of those employees. But if this is person contracting to you, are you in control of them when they're working for you? They're performing the work personally, and are they paid to achieve a result, or are they paid to actually achieve it on the hours that they're working? So that's one thing that's really important to document. Also looking at, are they integrated in a sense within the business, or are they working as a very separate part of the business? The result test that I touched on, what are they getting paid for? Are they getting paid for delivery of an outcome, or are they actually getting paid for the hours that they're working? The tools, are you providing the tools for them? So they turn up to work, you've got the bulk of the tools for them? Or are they being required to, as part of them delivering what they need to do, they bring their own tools and do that as well? So that's really, those ones are really critical on making sure. You want to make sure also on the risk element, who's at risk? If something goes wrong, if the job is not done properly, who's at risk on that? Is that falling back on yourself? Is there any risk for them? What happens if the job isn't done properly and there's rework to be done? Is that something that they're going to have to do that work at their own cost, or will you be paying them to do the rework? If you're paying them to do the rework, sounds a lot like an employee from that perspective. And delegation, would you allow that person to delegate to another person, or are you paying for them to be doing that work? And so looking at then on the business expenses, are they being reimbursed for maybe different business expenses like you would an employee, or is that part of the overall service offering that you have with them? Are you making them wear a uniform? Now, a uniform alone isn't always going to be the case, because you might have contractors, you might have certain jobs where wearing a uniform is actually required when they have people go on their premises. But it is one of the other areas. Then the other bit is looking at just some other factors, whether you have the right to kind of dismiss them, exclude, you have exclusive rights on it. So if you're saying to them, you can only work for us and no one else, that kind of alludes to them potentially being an employee. So it's worth going through all of those particular areas, because the person you're dealing with is most likely going to want to be a contractor, but you will be the one that wears the brunt of if there's a dispute later, and the superannuation is probably going to be your biggest one. But what we're actually seeing now, and anyone that knows me and knows me dealing with tax, payroll tax is just the worst of all taxes. I cannot stand it. I just think it's the most negative tax. But what they're doing now is where someone is being found that the person should have been an employee and super should have been applied, the ATO is now letting the SRO know, hey, by the way, this person they're a contractor, but they're a contractor under employment law. They need to pay super. So State Revenue Office, you need to get onto them about payroll tax as well. So they're really sharing the data around. We're seeing a lot of payroll tax reviews focused a lot around contractors and them actually digging into the details. We've had some clients where they've just asked to see their P&L, and then asked to see the full account transactions listings of the contractors, and then they've asked to see about 20 of the invoices from the contractors that have not been claimed as being contractors under employment side of things. So it's kind of what I think is, I look at it as making sure that you're asking all the right questions with the contractor. Your default would be nearly to say, I think I have to put you as an employee, and therefore that, $75 we're agreeing on paying, I'm going to have to withhold super on that because your package is inclusive of super, unless we can go through this analysis and prove otherwise that you're in fact not an employee, and then document all of that process you're going through. Now, I am just going to highlight, I know no one probably gets excited about high court cases. I certainly don't either. I am not a tax lawyer. I'm an accountant. But these two ones were quite interesting. And the reason I say that is that these are cases that people get pushing and pushing and pushing, and this is the lengths that people will go to in trying to do it, and why we want to get it right up front. A labour hire company, the High Court held that the worker was actually an employee, so it was a labour hire company, and they could control people that they had working for them. The worker was promised to cooperate in all aspects and comply with the labour, and the ability to supply the compliant workforce kind of worked out to be a key asset in the labour hire company's business. So that's where you're getting, some labour hire, but you're paying them as a contractor, but you've been able to control them. So that one was actually found that they were therefore a contractor under employment. Now this one's another one. It's a bit like that other one I was talking about with that trades business. This one was actually, the High Court held that these two truck drivers were not actually employees. Now this is where these things can happen. The two truck drivers had been working for this particular company, and after about 2-3 years, probably over a beer or something like that, the business owner and the two truck drivers, all came up with an agreement. Yeah, sure, I will hire you through your partnership. That's no problem. You go into a partnership with your wife, both of you, and you both go and buy a truck, and I'll hire you as contractors through, and you can just contract. Means you can split income with your wife, and that's a great outcome for you, and everyone's happy. So that happened. 22 years later, so clearly a dispute came up. 22 years later, those two truck drivers tried to claim that they were actually employees because they worked solely for this particular business, and that they were entitled to 22 years worth of super. Now, the issue you have with superannuation, and if the courts find against you, they actually can go back a long time. Now, 22 years worth of super, not to mention you'd have to pay the super, but on top of that, you've actually got to pay all the penalties, interest, and lost returns on that super. It could have been a hefty. So that one actually ended up at the High Court because some of the lower courts agreed with the truck drivers. It kept going up. And in the end, the business was successful. It was found that they had supplied equipment. They were being contracted to deliver outcomes on every job that they produced. And so going back to those key criteria that I was talking about, it's really important. Are you paying that contractor to deliver an outcome, or are you paying them to deliver their service of their hours and their efforts that they're currently undertaking? So they're just some really key points, but you can see the magnitude that it may not be today or tomorrow that you have an issue with it. It'll be when there's some dispute coming on and all of a sudden someone says, hey, I might try and go back and see if I can get 20 years worth of super, even though I've been paid at a contractor rate. So those types of things is really just looking at how can you protect your business from that perspective. So it really is also looking at going, can you contract around this, or how do you do that? It's really about, I look at it as telling the whole story, looking just beyond the terms of the contract, looking at what are you doing. So making sure, A, you've got a contract in place. A lot of people have just a verbal contract. If you have verbal things going on, start following up with emails as discussed. Can you confirm? This is what we were talking about. Now, it used to be quite good with the employee contractor tool. I used to encourage a lot of clients, get your contractor to fill in that tool if they say they're a contractor, because they always want to be a contractor. Get them to fill in the tool and send you a screenshot of the outcome. You fill in the tool, and let's see if you both get the same outcome. And if you do, put those on file, have an email back and forth. That's going to put you in a really great position. It's a real problem that tool has been taken away. We had expected it back already. It's been a few months now, and we've had all of these court cases come out. So there's a real focus on it. And I've seen over the last month, the State Revenue Office all of a sudden getting all excited about extra money on these contractors. So it's important to have a contract in place with these contractors to do in what they're doing, but also look at how are you actually working with them. And if you need to, put that little file. Maybe you get those key points that I talked about earlier and say, and look at aspects like, delegation, the integration in the business, business expenses. Maybe address each of those and put comments so that you've got your file, that if that happens, you've actually got something that is there. Because from your perspective, it's always safer to have them as potentially a contractor that you're then paying super on. So they may not be an employee, and they're contracting either via an entity, which I'll touch on a bit later, or directly with you, but they're really acting like they're an employee. Now, with those situations, going back to your $75, I'd be saying, well, it's 75 inclusive of super, because you're not going to pay 75 plus super on top of that, unless that's part of your negotiation. And then in Xero and whatever software you're using, you can actually then record their super and pay their super. Now, if you're paying their super and they're a contractor in that type of situation, unfortunately, that's going to be one that you're going to pretty much be looking at your payroll tax, looking at all of your other work cover, et cetera, on it. But it is something to kind of make sure that you've got that part covered, so you're not getting that surprise later. So if they are remunerated mainly for labour, no right of delegation. So this is the superannuation rules. And that's one thing to kind of touch on. The definition of small business, there's something like 26 definitions of small business amongst all the different tax acts and all the different business legislation. Definition of an employee, there's over 10 as well. We don't have a one-size-fits-all definition for payroll tax, long service leaves, superannuation, PAYG. It's been something that they've always talked about unifying, and it has never happened. So it's quite frustrating that you do need to go and look at each of these definitions, which is why on this employer hub, we're hoping to kind of make it a little bit easier by bringing them all into at least within a short space of each other, so you can look those up. But when we look at superannuation, it's really focused on, are they remunerated mainly for labour? They've got really no right of delegation, and they're not paid to achieve a result. If those three apply, without a doubt, you're liable for super. Without a doubt on that. It's very hard. So that's something to really have those discussions up front with someone to make sure that you're aware of that in the negotiations of your rate, because you're going to be paying that on top as well. And I had another 2 cases. I know none of us are excited about cases, but it's just the key messages that I think have come out of it that put some realism around what it is. Drivers, and these were kind of pizza delivery drivers. Now this went up in the lower courts, and then it was found that they were employees, and then they weren't found they're employees. I mean, a classic one that they're trying to run at the moment is whether mortgage brokers who work under licensees or aggregators are actually employees of the aggregator. What a nightmare. Payroll tax is trying to go after that at the moment, when they're clearly running their own business. Makes no sense. So with this particular case, what was interesting on this was, and what was the defining bit, so this is just so that you can think about it when you're looking at the contractors that are working for you, is the delivery service included a labour component, but was not the principal benefit. So there was more than just their labour. It was then obviously the delivery truck and everything else that went with it that actually provided the service. And that's why they were not found to be employees. Another interesting one, they had a university lecturer who was a contractor. You could probably say a bit like what I do for the Melbourne University. I'm a contractor for Melbourne University. I am not an employee. I teach one subject a year. That's all I teach. They don't have any control really over me. They give me very limited, so very similar to this case. This is not me. Very limited parameters over what I need to, here's what I need to teach this level. You decide how you teach it. I get a contract, and I actually can get guest speakers in and things like that. So a lecturer at uni tried to say, well, no, I'm actually an employee, and they tested that one out, but they weren't successful because of these different parameters. So you can see how those, on that slide that I had, the 9 little boxes, there's no one size fits all, or if you do one, you satisfy the other. So it's some of those things that you need to be kind of aware of and making sure that you've got that file. It's annoying to add on top of everything else you're doing as a small business owner, but it is something that we're seeing just more and more people just want, unfortunately, free money. And they think, oh, well, I've been contracting all this time and I've been doing it all for one person. They should be paying me super. Now, if you start to find one of your contractors, started as a contractor and then kind of nearly became an employee, they used to have lots of other people that they did it for. They used to supply the tools, and then over time you started to supply them. Then they wore your uniform. Before you know it, they look like they're actually working for you. You may need to revisit it, maybe something that once a year. So you can also show on file, should you ever have the situation, where you just go in and review each of those contractors and say, are they still acting as a contractor? Or are they more now, in fact, an employee? And should I be having the dialogue with them as well? And even in the contractor, if you're looking at your rate, I would be saying something that my rate is the rate that we've agreed is inclusive of tax and any other charges such as super, et cetera, so that if in a year you have to go back to them and say, yes, you were a contractor at that point, definitely an independent contractor, 75 an hour. However, now you've given up all of your other builders that you work for. You're only working for us. You're now using my tools. You're wearing our shirts. You're really more of an employee. As I had said, that rate of the 75 was inclusive of taxes and any other charges included super and all of that. I now need to start withholding super from your package. So those kind of things can really help you at that point. Now, the issue with how far can the ATO go back when it comes to this? This is the really big issue. On everything else, you can only amend 2 years. On some things, it's 4 years, yet they expect you to keep the information for a good 7 years. On this, generally, some have a 4-year limit, but on the majority of it, it's unlimited. They can just go back as far as they want. Hence the reason those truck drivers thought they'd, give it a whirl and see if they could get 22 years worth of super back. So it's really something that you want to make sure that you just take that little bit of extra time to document, keep your emails, put them all in one folder, PDF the emails so you've got them all saved so that if something comes up later. So then you think, oh, that's okay. What about I just contract out a super? Let us all just agree, because my contractor doesn't want me to withhold super. They want to deal with their own super. Can you do it? So the parties agree, the worker's an independent contractor. Now, if you'd asked me about 10 years ago, I would have said that this type of agreement, you probably would have been okay, actually, 10 years ago, potentially. But with all the court cases we're seeing, the short answer of contracting out of it is probably no. So you might have a contract that says this, but what else is it that you did? Go back to those 9 little boxes. What are the other aspects? So this can still be in your contract, but you need to look at all the other aspects that you're doing. Because if you go back to what I talked about with super, can they actually, they've got the 3 points on it, whether they can actually, let me go back to my super one. If we look at, they're remunerated mainly for labour, no right to delegation, and not paid to achieve a result. You can't contract out if those 3 apply. The superannuation rules are going to ignore that part of the contract. So going back to one of my earlier points, it's more than just the contract. It's all of those other aspects. And those would be some things that you would be bringing up with that contractor to make sure that they, also look at those considerations as well and understand where you're coming from. So what is it that you can do from that perspective? So written agreements, that always recommend having a written agreement or email confirmations or something to substantiate what it is that you've actually been doing. And if in doubt, treat workers as employees. If they are acting like they're contracting for you on a normal basis, they're turning up, they're doing what they're asked to do in those times, and they would have super. So thinking about that when you're negotiating that hourly rate with them to make sure that you've got that part covered. And then looking at the ATO has put out a risk framework. Now, it's this PCG 2023-2. No one's going to get too excited about it. It is something that I've pulled out some of the key points on that, so that these points, I'll go on the next slide with those. if you satisfy those, then you're in the low risk category. But that's probably the best bit of clarity we've received from the ATO. At least they've put that out, but they haven't yet put back that decision-making tool. Now, interposed entities. What we mean by interposed entities, this is where someone puts themselves into a company and says, "Oh, it's okay. You're contracting me as a company or through a trust, and so there's an entity there, so I don't need to do the super." The rules can actually look through those. So it's really important to make sure that you actually document and don't just assume because you're dealing with a contractor that's in a company or a contractor that's in a trust, that all of these rules just all go away. Because what you can see with some of those court cases is, the truck drivers, they were in partnerships. You've got others that were in other entities. Those things are being attacked where it's actually they're turning around and say, and Roy Morgan, which is one of the big investment, the researchers, they had this where they made every contractor for them go and get themselves in a company, and so these laws are being looked through, especially around super. So don't just assume that you don't have to do anything because they're in a company. Now, if I go to the PCG, what those PCGs mean. A PCG, not that you want to know all the details about the tax office, but they're usually, I find they're good things. And the ATO has been doing them a bit more now. What it is their guidance that they give kind of to tax agents and the wider whoever wants to read them. And it says, these are our internal guidance as to how we're going to review these situations, just so you're aware what we're going to be looking at. So that's really helpful to know what they're going to be looking at and how they're interpreting the laws that are out there. So they actually have now the PCGs, what I quite like about them, they have traffic lights on them. So they have green, you're all good. If you satisfy all of these things and you get this score, which falls into the green, thumbs up. We're not even going to look at you. If you're in the amber, there may be some concerns. And if you're in the red, you might want to look at fixing things to get yourself in the amber or in the green. So you can do these types of analysis. We do some of these PCG analysis for clients when they're maybe consultants and earning a lot of the income themselves and trying to put it through an entity, and how much should they declare in their own name. But this one is one that from a contractor's may be worth having a look at. So what's in the low risk category? Evidence that both parties agree on the classification. So going back to originally when we could do the employee versus contractor tool on the ATO, hopefully that comes back soon and both of you do that. A comprehensive written agreement. So you've even agreed on it. If you don't have that, at least if you've got emails back and forth agreeing on things. Okay, Bob, so based on this, based on the fact that you've done that checklist, we've done this. So you are an independent contractor, you have other clients, as we understand, you're working for us 2 days a week, you're doing this, this, and this, and this is why we've both agreed. Evidence that both of them understand the tax and super. So Bob, you'll be dealing with your own tax, and there's no super liability because under those rules, you're being paid for an outcome, not being paid just for your hours. You're supplying your truck, and if you've got someone else having to work on that truck, that's okay as well. You can delegate it, no problem. So those types of areas, and then the correct tax and super obligations for intended classifications are then met. So you actually then did it. And if you maybe obtain specific advice for it. So that's where some clients have actually had us kind of work through this PCG kind of analysis and go through it to kind of have it so you can evidence at that point, or you got advice from others on that. But they're the kind of low risk category. So you've got your file on it. It's a file you hope you don't ever have to end up using it, but it'll always end up coming up. I've seen cases where someone's worked for someone, for 10 plus years as a contractor. It's always been what they've done. And then things go sour or people just get greedy, unfortunately, and these types have happened. So then you look at, and I've had this question a number of times, okay, well, what about if I just now close the business? Because sometimes the debts get really high. Closing the business and make the problem go away, unfortunately, it doesn't, because a number of years ago, they changed the liability on PAYG and also superannuation. Directors can become personally liable if the company fails to meet their obligations. The ATO can issue a director penalty notice, and then the penalty is remitted when the company pays, obviously the outstanding amount. And, look, there could be some options depending on what amounts are reported to the ATO, but you really can't just close the business and make it go away. So some of the key takeaways, and the reason I started with contractors and employees, the surprising ones I've seen of late is the fact that this has happened in administration. You've had someone who's worked 2 days a week in administration coming in, 2 days a week, school hours, put through the family trust of, the business owner, a business owner is running their own business, but put through and things like that. And, work doing admin services, VA services for others, and now they're going after superannuation and things like that. That type of one should have been one that I think someone would have gone, oh, I'm trading with a trust, so therefore I don't need to worry about these rules. Well, they really were acting as an employee, so that wage that you quoted to them, or that payment per hour, inclusive of super, if you'd paid super on that, you'd be all good. There'd be no issues. So, again, someone's just going now for super on top of that. The business owner thought, oh, well, that's okay. They were in a trust. They were working a few days. It was going into the trust. So it's in a trust. I don't need to worry about it. So it's those little things to really make sure that you get those right so that you're not getting that coming back to you later. So PAYG withholding sounds easier than it is. Now, for 90% of the situation, it is kind of quite easy, and the software does it all for you. I just want to go through some of the key areas to alert you when you might need to either call us, look it up a bit more, look for a few more check boxes in your Xero just to make sure you get it right. So when we look at PAYG withholding obligations as an employer, you've got to identify the payments that are subject to withholding. Again, of course, there's no one-size-fits-all definition. So we will put, with this webinar, I'll then put some links to, what are wages in accordance with from a PAYG? What are they with super? Because some of them, it's always worth checking to make sure. You paid someone a bonus, was a bonus for overtime hours, no super on it, yes, PAYG. Bonus for doing a great job, there's super on it, and there is PAYG. So there's all these different definitions. You are then going to calculate the PAYG, which 99% of the time system does for you, which is great, report it to the ATO, and then remit the dollars. And as the single touch payroll is going, before you know it, you'll be pushing the button and everything will be going across to them. So identifying payments subject to withholding, and you are liable to withhold. So if you don't withhold, you're going to be liable to make that payment. But, your normal salary and wages, remunerations to a director of a company, even if it's you, you are required to do that. Salaries to office holders, payments under labour hire agreement, if that's way, unused leave payments, and then also salary and wages under, if you have seasonal labour mobility program, there's some special rules on that. So some of the allowances, exceptions, and a lot of people are not aware of these, and these can be useful for employees having more money today than later. And the main reason for these ones is if the person is going to be claiming a tax deduction for this, then what the ATO is saying is you don't have to withhold the tax when you pay them that allowance, because they're going to be getting a tax deduction for it. So that will negate it out, and there won't be any extra PAYG. If you forget to do this, then more PAYG is being withheld, and the employee will get a nice refund at the end, but that's just to be aware of it. So it could be if they've got the 5,000 business kilometres and they're getting an allowance from the car allowance from that perspective. There are some award transport payment ones, so that would be related to your particular award. So have a look at those ones. And in some of the awards can be really quite complex. It will say if you pay this allowance, then they get this is tax-free, this isn't tax-free. So there's a whole bit of a schedule on that. If you're using Xero, you can add each of those allowances as different allowance types, and then you can mark them literally just once. It's taxable, it's reportable on their overall payment summary, I still call it, and is super withheld. So you can kind of go through once, but it will be related to the award, laundry, meal, overtime allowances up to a reasonable amount. There is a definition of what's a reasonable amount, and that may differ by award as well. So you can just double check on those ones as well. And some of the travel, if you're reimbursing some of that travel or reimbursing, but so if they're getting an allowance, and then they're going to be able to claim some of that as well. Some of the differences when you're calculating the PAYG, obviously got it based on the normal rates. I assume everyone is using an active accounting software now that's up to date, unlike some people used to use desktop and never update the PAYG. We have new rates from 1st of July, so people have more money in their hand, which is great. But there will be some adjustments potentially for Medicare levy, could be for your help debt, so some of your university student type things, making sure that you ask that question so that you know that if they do have these debts that you tick that box, so that's coming. Residency status, I'll touch on foreign employees just a bit later in the webinar, because that's really important. That really changes the threshold. Anything on the tax-free threshold, and then on tax offset entitlements that they may have, so that they have a lower PAYG withheld for the moment than waiting for later. And some of these where you might also have, if you have an employee that has an investment property and they happen to say, oh yeah, every year I get a nice big tax refund because of my investment property, if they happen to talk to you about that, but I've done this for a number of clients on it. Well, if they're getting a certain amount at the end of the year, and that's kind of continual, they can actually fill in a form to vary their PAYG. So instead of getting a $6,000 refund at the end of the year, you can get $500 extra a month back today, and at the end of the year, it'll end up about square. So you can just look at the withholding rate tables. A lot of us don't bother looking at those because our system does it for us, but there are different rates for termination payments and unused leave on termination. And then there are some special rates, which I'll talk about in the foreign section, on working holiday makers. This is really important. I get this question a lot from clients, and it's one usually that the worker gets very upset when they see how much tax they're paying if it's not correctly ticked in Xero as well. So that's really important. And there are some special rules, won't apply to probably many of you, but labour mobility schemes have some special rules that apply and some special taxes. Then you can report it with a single touch payroll. So they've changed the timing and frequency of reporting it. They want the information more accurately reported. Now, having this information, you might notice you get literally mail straight away if you have not put your super in on time as well. So they're getting the information that's coming from single touch payroll, not only when you go in to look at your BAS, they're checking to see if you've lodged everything and see if you've got that same amount. They're also sharing that data across the board as well. I believe, although I have never seen it factually put anywhere, that a lot of the data is being shared across in the Centrelink world as well. But I know a lot of this is being shared with State Revenue Office and a lot of other bodies as well. So some of the mandatory versus, like, I guess what we'd say voluntary reporting, so mandatory salary and wages, remuneration, all of those different aspects, which are quite normal and we'll get through. Some of the voluntary is where reportable employer super contributions, if it's required, not all of them are, reportable fringe benefit amounts. If there's been any payments covered by a voluntary agreement, someone's put their hand up to want to pay more because they know they're going to have it later on, or some of that, or certain labour hire arrangements where you've actually put that through. What you can't report through, anything to do with super income stream payments, dividends, interest, royalty. You can't actually adjust that and report PAYG on some of those other parts. So anyone that's had employee shares, so the employee shares, they don't withhold, and you can't kind of record it, they don't withhold the PAYG taxes. So a lot of those people that get employee shares, working for some of the big companies, don't have tax withhold, get really excited when they're getting all this extra money, and then don't realise that they've got all of these shares. That's great, I've got these shares. I could even go and sell all those shares. They don't realise they get a big tax bill come the end of the year as well. Also, just because you're the business owner They have changed through single touch payroll. You might recall often we waited till the end of the year, did your wages, and recorded yours through. What they're looking at doing now is the ATO wants the closely held payees, that means business owners, to have actual payments to lodge it through single touch payroll on or before payment. We're not going to do that every time you happen to take cash out of the business, because that would be very annoying. So that's going to get reconciled to your director's loan. It could be something you do actual payments quarterly, or it could be a reasonable estimate quarterly. So depending on what your situation is, you might see sometimes you'll be doing it quarterly or monthly, but they are wanting to get that on regular, closely held payees, where you're regularly getting a wage rather than it just being on an annual basis, which used to be the go-to and easier way to do it and used to never be an issue with them. Now, when you need to then remit this to the ATO, many of you will find that that all of a sudden you used to lodge your BAS and that was fine. And now the ATO wants you to lodge IASs, so instalment activity statements, so every month. That's a small withholder. If you're less than $25,000 worth of PAYG withholding, you can stick to your quarterly BASs and you're okay. As soon as you have more than 25,000, I'm picking, there's not many on this call that are doing more than $1 million of PAYG withholding. But as soon as you've got more than $25,000 of employee taxes that you're withholding, which, let's face it, on a $100,000 wage, 25,000, effective rates around about 25%. So there's your 25,000. There's not many people now. That threshold used to be a lot higher. So that's why so many people are having to report monthly and actually lodge that IAS each month. The ATO, one of the triggers, and for some of you that are not aware of it, so I used to be on the Board of Tax Advisory Panel, advising government on tax laws and trying to keep things real. I'm no longer on that. I'm now on the ATO's Small Business Stewardship. So my kind of job is to represent small businesses, not with my accounting hat on per se, but as a small business owner and dealing with lots of small businesses, to tell them when they do lots of things stupid. There's a lot of things that we get to say to them every month when we have these meetings, and they do listen hard on it. This issue on why they changed the threshold came up. The ATO see, and I see some reason behind it. We kind of say, well, at the end of the day, you're actually causing more burden on a lot of small business taxpayers on having to do it monthly. The ATO's view on this is we believe that we're actually helping taxpayers not get so far behind on their tax debt, because they have a lot of stats that show when people get that quarterly shock, that tax shock, even though they should have budgeted for it, there's a lot of issues. So that's why they did change the threshold. It does add a lot of more administration compliance, but that was why they did that. And unfortunately, fortunately, the stats do prove that actually that has been a good thing from a debt recovery. Unfortunately, it puts burden on all those that would have been doing the right thing. Now, your failure to remit and or report, and the reason I highlight this is in 2019, they changed the rules. And if you don't remit your PAYG taxes, they're not deductible. You cannot claim them as a tax deduction. So if you pay them really late, bad luck, no tax deduction. And if they then do come after you, the penalties are exactly what the tax was. So there's a real push by the tax office to say the PAYG withholding was not your money. It's your employees' money that you withheld on their behalf, and you need to give us so that we can consider it as part of their overall taxes. Now, this rule's been in place since July 2019. I haven't seen, to be honest, it being enforced at all. And I've seen a number of clients be late with their, PASs and IASs and all of that. I think COVID probably cooled their jets a little bit on going after taxpayers. So I haven't seen them actioning it, but it doesn't mean they won't. So it is one of those things to really try and keep on top of, because, as the tax office does and state revenue, they get a focus on something and then they go full powering along. Obviously, when people commence, there is the single touch payroll forms. They're in your system, software system, your tax file number declaration, super choice, and all of that. And you can lodge it through the to the ATO online, through your MyGov or through your software, and going through that. So I am going to go over the 1 hour, but I am recording. So if you do have to duck out and leave, you will get the recording and go through. I just didn't want to extend out. Once I started to get into a lot of the details and feedback we got with some people, I realized that the 4 sessions are going to be jam-packed. So if you are leaving now, definitely make sure you come to next week's one on employee allowances, because that is going to be the best one on how you can do a win-win for both of you, where you as an employer spend X amount, the employee as part of their package, it's the same X amount, but it's worth more to the employee, and there's some really good, it's going to be the best one, let me tell you. But anyway, I'm going to keep going, so hopefully you can stay on the line for another half an hour. But if you can't, there will be a recording, and it will be worth having a look at some of the other topics, especially around the long service leave and payroll. Now, foreign employees, you might think this is not going to be relevant to me. This one, not relevant to probably too many, but the next one will be. Foreign resident, you may have a foreign taxpayer. If you do, so they're not a resident for tax purposes. They can be foreign, but not a resident for tax purposes. Someone can be foreign and a resident for tax purposes. So it's important to ask. Most of the time, what you will find is they're foreign, but they're a resident for tax purposes. So you won't come across this much, but just to highlight, if they are foreign and they're not a tax resident, so they're not going to be lodging their taxes here as an Australian tax resident, they don't get the tax-free threshold. They pay 30 cents in the dollar tax from zero, okay? They don't have to pay Medicare levy. So you've got a few little boxes to tick as well. But what is one that's going to really be relevant to quite a few of you? I've seen this come up from a variety of different industries, is the working holiday maker, or commonly called the backpacker tax. There was a special, of course, just to make things more complicated, but there was a special tax that was put in place for those that are working holiday makers. So they're foreign, but they're an Australian tax resident. They're not technically a temporary resident. They're not entitled to, they're not an Australian tax resident under the pure tax residency laws. And so they don't get the tax-free threshold, but they pay 15 cents in the dollar from $0 to $45,000. So those ones are the certain visa classes. So anytime you get a foreign worker, ask them for a copy of their visa. You need to understand what visa it is and look up what the implications are for that visa, because they're a temporary tax resident. And if you're not sure, contact us and we will look up if it's, and check which one it is. But someone can be maybe not on one of these two visas, but be a temporary Australian resident, and then they have certain rules as well. But if you have the backpackers, we get a lot of labourers and trades in that, a lot of the hospitality. So it's very well that you may actually get one of these. So they're going to be taxed at 15 cents in the dollar, no tax-free threshold. They're not usually that happy with that, but making sure you check some of those. Now, the interesting thing about it for you as an employer is if you don't register because you've got more time to register for another thing, but you need to register as a working holiday employer. If you don't register, then you need to withhold 32.5% of the employee's taxable income when it's less than 120,000 based on the current rates. Do you think they're going to be very happy with that? No, not when they could be paying 15 cents in the dollar. That's really easy to register. It takes you 2 seconds. Literally Google ATO, working holiday employer, register. There's a form and you can lodge it through, do it through your business portal. We can always do it for you. Lodge that. It just goes into someone at the ATO. Sure, they do nothing with it. But anyway, once you've done that, you are registered. So that's all good. And then you're going to go into your zero. And when you go into your zero, you're going to make sure that you go into the employee tag, and under the employment income tab, you're going to look at the type. Normally you just default to ordinary income or salary and wages. Look in the click down box, third one down, and it says working holiday maker. You do that and everything else gets updated for you. It's fantastic. It ticks all the boxes for you. If you had a foreign worker who's not a working holiday, then their normal salary, and then there's another one in the tax tab where you do foreign resident. So if you're not sure on those, we can always help you with those to make sure you get it right. But when you do their first pay run, have a look at what the effective tax is and see if it kind of comes out to what you're expecting. Like if they're a working holiday maker, 15 cents in the dollar, have a look at their tax. Is that tax 15% of the wage that they've earned if it's under the 45? And you're all good on that side of things as well. So you will find that those little things, once you've got it set up, okay. But I've had the number of times I've had clients call me and go, my employee's not happy. I've taxed them and they say it's too high and this is why. And we've looked at, they just missed one little tick box and they've just been able to fix that up. So another area I wanted to cover is long service leave. We do have, a lot of people do change jobs, so maybe that doesn't happen as much, but there are, quite a number of employees. So long service leave, employees under law, it is a legal requirement, are entitled to long service leave, depending on how long they've stayed and the different various states. But once they get to 7 years of continuous service, they get pro rata. They can pro rata and take some of that long service leave. So it does look on what is that continuous. There are some little definitions. But in some industries, employees in security, community services, building and construction, and you need to look at the detail of building and construction because it doesn't cover every single type of industry under building and construction that you may think of. Coal mining, contract cleaning. Contract cleaning is one that I think a lot of people miss. Now, they can have access to what we call this portable long service leave. So many of you have probably heard of Co-Invest. They've renamed themselves Leave Plus. That covers building, construction, electrical and metal workers. But not all construction workers are covered under that. So those ones mean that even if they change jobs, you're paying long service leave to, say, Leave Plus on their behalf, and that organisation will deal with it. If you haven't got that, employees employed directly by you, you will be required that once they hit the 7 years, and I've got quite a few people who are clocking up to that at the moment. Got Nicole 10 years now, so she's clocked up to her 3 months long service leave, where you're going to have to be giving them that time off. So it is something that's worth thinking about. So how do we calculate that? Now, your software will do that for you. We do have a video, I've got the link there, on how to add long service leave in Xero. And so that's something that you can start at calculating for you so that it will automatically calculate the long service leave on it. Now, you are not legally required to pay any portion of it until after 7 years. We recommend you start recording the liability on your balance sheet at about 5 years, because usually once someone's been with you for 5 years, it's more likely than not that they're going to stay potentially with you, and that you might have that liability coming as well. So now I wanted to touch on work cover. Work cover is almost becoming nearly as painful, I guess, as payroll tax with the amount of increases we're seeing. Whether, again, there's been a lot of problems in the work cover system. I think you've all probably heard that on the news and a lot of discussion on that. And unfortunately, all of us business owners are wearing the cost of that they're significantly increasing on work cover. So just to kind of step back and go, well, what is work cover? Aside from being a lot of money in some instances, especially if you're in the trades, and painful, what was the whole intent? And I think when you look back and think about what the intent is, I kind of get it. I just wish I could control it a bit more myself than have others controlling it that maybe don't, that maybe mismanage things and could have managed it better, let's just say. But work cover is just another type of insurance. And this is where it comes back to also your contractors. So think back to those in contractors. Does your contractor have work cover? This independent contractor, do they have their own work cover? What happens if they have an injury at your work site? Who's liable? So work cover is trying to cover and provides wage replacement, medical benefits, etc. No fault basis and supports dependents of those who have passed or, and entitled to compensation. So I guess what you're trying to look at with work cover is it is another insurance, and therefore going back to that employee contractor, if that contractor, hurts themselves on your premises, what happens? And that's a very open question to have with them. Is it your public liability that kicks in, or do they have their own work cover? If they have their own work cover, that's great, because that's really pushing you towards the fact that they are probably a contractor because they've got their own work cover. If they don't, there's a risk for you, because if you don't have work cover and you've said they're a contractor and they're not an employee and they hurt themselves on site, they could come after you on that. Is it under the public liability, or what will they be coming after? They're not entitled to work cover. All of a sudden, every contractor wants to be an employee once they get, injured or something. So an employer's responsibility, you need to accurately calculate the premium based on your payroll, ensure you're keeping proper remuneration post-claim, and maintain all of your records as well, and focus on the occupational health and safety as well. So I've got there a bit of a checklist of procedures I'm going through, and then I want to go through some of the details on it, because I think work cover is one that a lot of people feel it's a bit like a tax. You get it, you fill in your details, you submit, and you don't even know that there's a person on the other side. What you probably don't realise, and so for my work cover, I deal with Allianz. Now, I can actually contact Allianz and have a discussion about my work cover. They kind of manage work cover, I guess, on behalf of, WorkSafe, etc. It's worth having the dialogue with them, making sure you've got the right definition. What if your business has changed over time? What if you're changing that you've got, certain functions you're no longer doing? You used to do quite a risky thing in-house. You now use third parties to do that. Maybe you can actually, rechange some of that. So it is really worth doing that. But when we come down to a checklist on work cover, is make sure you're looking again at who's a worker for work cover purposes, and then just from your own liability, when you have a contractor, I put that as one of your confirmation things as well. Review any contracts with your independent contractors, deemed workers. Now also checking if anyone's working interstate or overseas and whether they should be covered or not covered. Have you got people that are working interstate, and are they working interstate? Now, each of these rules, of course they are, every state is different, but it's worth checking. You check with them, your Victoria work cover, and say, hey, I've got Bob and he's working down on a special project in Tassie and he's down there for 4 months. What do I need to do? Is that an issue? And do I need to do something in Tassie? And most likely, to be honest, the Victorian person will probably be able to say, hey, you better call the Tassie, and then you call them and make sure. You want to do that because otherwise there could be risks that come up as well. Ensure the premiums are up to date, and then making sure you've got adequate occupational health and safety procedures. Have a look at what they've got available for you, but by doing that and reporting that, you can actually help yourself on trying to get your work. Helps you if there is a claim to say, well, this may have been an abnormal situation, but also can help you potentially look at reducing as well. And then know how to process if you actually do need to make a claim as well. And then make sure you keep records of any of those claims as well. So they're kind of the checklist. I'd say that you want to go through once a year on your work cover just to make sure you've got on top. Don't just get your bill and whinge about it, obviously, because we all do, and then pay it and send it off. So let's go back to some of the basics on work cover. Who's administrating? In Victoria, we've got WorkSafe is administrating. Now, who's paying for the work cover? It's compulsory for all employers. Anyone that is paying more than $7,500 in a year, doesn't take much, needs to do it, even if it's for yourself as well, even if you're the director. I'd actually say probably even as the director, it's probably cheap insurance to have that extra cover for yourself as well. So, but what is the premium? What is the premium made up of? The premium is generally made up of the wages paid by the business, size of the bill, what is wages, what's the remuneration, super, all of those numbers. Your industry classification, so find out what your industry classification is to gauge a level of, and they look at the risk in that particular industry. Now, I know that probably a lot of you have seen your bills nearly even double. mine doubled. So I've just got to watch people don't fall over cables or something in an office or something. But ours, in an office doubled. And apparently there's been, when I questioned that on the industry classification, apparently there's been a lot of mental health claims, which interestingly enough, they've now tightened the definition of mental health claims. So it is now harder for people to claim on mental health than it was before. Before it was a bit of a free-for-all, and now they've actually made that a bit tighter, which is interesting. So then looking at your claims history, and so even reminding them if you haven't had any claims history as well, and just on the number and class of employees that you've got as well. Generally, it kind of is a factoring. The issue that we have, unlike payroll tax and things like that, you get here's wage, here's percentage, here's what you owe. These factors are kind of in there. It's getting the details of all of that. It's percentages of everything, and then it calculates through. So they need to declare that. You're doing that once a year. And, if it's too significantly different, if it's higher, they may actually, you'll get a refund for overpayment. If you underpaid, sometimes I have seen them want to issue penalties and interest on that, because their thought is that you need to update them when you're hiring more people as that time period goes along. So if you have a significant change in the number of your employees, do make sure you go onto your work cover and update your premium estimation. You'll always get a refund back if it's too much, but you just don't want to get dinged. They're not that lenient on giving some of that back to you if it's gone over. What does it cover though? I mean, if something does happen, it applies only to workers, but it does cover giving them kind of, their wages, medical expenses, sometimes lump sums, and, in the unfortunate instance on the death benefit. So there is some good that it has there, but I do understand because the work cover system is broken, all of us small business owners and big business are all helping apparently fix it by paying literally double on our workers cover as well. So some of the tips I would come up with trying to work out how can you manage it, or trying to control what you can't really control, but trying to do it. Review your rateable remuneration. Talk to them. Talk to the insurance provider, because you're not dealing just directly with WorkSafe. You're dealing with someone who's administrating that, and quiz if it has just had an automatic check your industry classification. Do you fit into a different category? And so checking those, and then making sure the employer, what they call employer performance ratings, making sure that all of that you're not getting grouped into a bucket of those that are not doing as well, and maybe you're doing really well. Talk about the different things that you have and why that's different. And now we get to, you should save the best for last, but I kind of haven't. Now we get to the worst tax ever. This is the tax that we thank you for hiring more people and supporting our economy, and we're going to ding you with extra tax. It's very, very frustrating. Even when I was on the board of tax, we've done lots of numbers to show if you increase the GST from 10%, and GST is a state tax, by the way, payroll tax is a state tax. If you increase GST from 10% to 15%, which is actually lower than most of the OECD countries, most OECD countries, the GST is 20%. So 10% is really, really low. If you increase it to 15%, we abolish payroll tax, but no one's game at a federal level to fly with that argument. So we've still got payroll tax here. They are increasing the thresholds to, I guess, help small business a bit on that side, but I still find it, a bit of an offensive tax for being rewarded for hiring extra people. And so when you look at hiring that new person, you're like, wow, that person's going to cost me X amount, and they think they're getting paid that, and I look at them and think, well, you're going to cost me nearly an extra 5% as well. So that is a bit frustrating. So the new threshold is 900,000. If you're in regional Victoria, you actually thresholds, you get different rates. Like you, unfortunately, on the Mornington Peninsula, we are not regional, so we are having this as well. Again, we have each of the different states. Now, there is a real push on the payroll tax from a Victorian perspective, in that other states have a lot higher threshold for small business. So they don't pay payroll tax till their wages are at 1.2 million and things like that. So it is something that each state has their own thing. Again, you need to have a look, and if you've got workers working for a particular period of time, you need to make sure that you now may be liable to pay payroll tax in that state. You don't have to then pay it in Victoria. So worth having a look at that. So what are some of the payroll tax obligations for employers? Register. You need to register within 7 days. Northern Territory gives you 21 days. Everyone else, 7 days after exceeding the exemption threshold. Now, I'm sure that many of you do your wages and you don't go, wow, I'm over 75,000 in contractors' wages and super. Quick, 7 days, I'm going to register. That is unfortunately the expectation. You can, you might register at a later point in time and ask them for, forgiveness and try and negotiate out of some extra penalties they do. Sometimes they waive you on those parts, but it's very frustrating on that side. Monthly returns, once you've registered, it is monthly, which is very frustrating, and it's due by the 7th day of the following month, 30th of June, 7th of July, 31st of July, 7th of August. So your monthly returns, you need to be on top of very quickly. You then are going to be required to do an annual reconciliation of the payroll tax paid with your actual payable of tax. And that's going to be where you want to make sure, sorry, this throat's still a bit of a problem, that you've actually got all of the contractors that need to be included or not included. Record keeping, make sure you keep all of the different record keeping, and there will be certain exemptions. Maybe talking too much. We're on the home straight. So payroll tax thresholds. Now we look at the thresholds. The threshold did go up from 1st of July 2024, which is a great outcome for all of us. We're getting you all to read the slides at this point. Give me a second. So looking at what are your wages for payroll tax perspective. Sorry about this, but we are looking at 900,000 threshold and 75,000 is the monthly. So what does that look like when we're looking at what are you paying? What are the wages that you're actually applying? What are you paying payroll tax on? And this is going to be different for every single type for different wages. So again, looking at your superannuation, looking at your payroll tax. Oh, I've got more water coming too. Must have been loud coughing. Sorry, Bill. This is going to apply with your different super, different, what's the wage for super purposes, what's the wage for work cover, and what's the wage for payroll tax. So it's really important to have a look at this and looking at your contractors as well. So you have a basic calculation, what is our actual wages, and then we take the deduction. That's the exemption threshold. That's the 900,000 that we're going to take off. Okay, and then we're going to have tax rate applied only on the above. A lot of people think it's applied on all of it. No, it's only on the wages above that threshold. And as I mentioned, there are different thresholds with the different states. Like South Australia, I want to say is like 1.1 million or 1.2 million is their threshold for small business as well. So again, go back to your taxable wages and your employee definition and making sure that you've got that, what constitute a taxable wage, because the wage includes any of those kind of allowances and super and all of those. And that's why I see many clients have not, they're processing their payroll each month, especially if you're processing it each week, or if you're lodging your monthly IAS, you might look at your monthly IAS and go, oh, my wages are still at 55. I'm under the 75. 55 plus your super, add those together and think, am I over the 75? And do I have any contractors that I should be including in that as well? Just to keep an eye on it to make sure. What am I seeing the payroll tax focus by the SRO? They are just going crazy at the moment. the SRO, clearly we all know the Victorian state government is broke. Payroll tax is a huge focus area. They are coming after people in left, right, and centre. They have so much information and they are sending letters out. If you don't have audit insurance, please contact us and make sure you have it. Your audit insurance covers the payroll tax. Doesn't cover any tax if you're found to be not doing it right, but it covers the review. The number of payroll tax letters we are getting. I can even put my hand up. They gave me one at Smart, but guess what? They didn't get any extra money, but they still sent me a letter because they got the details and they thought, oh, we want to make sure we check these things. And they are checking everything. They're checking for employers that are not registered as an employer but should have. How are they getting that? Single touch payroll. They're going to find out about it maybe before you realised that you need to be registered. They're getting your single touch payroll information and they're going, okay, in the month of July, you paid 80,000, but then you maybe dropped down. Maybe it was a bonus one-off month and your overall annual wages is not going to exceed the overall threshold. You're still going to probably get a letter from the State Revenue Office and you're going to go under review. And then you're going to have to pay us and waste time on your side to put together all the responses, because they don't just say, please explain. They want everything, including the details on your firstborn. Seriously. They want the last 3 years' worth of all your payroll records or payroll payment details for all your every employee. They want all the details of the account transactions of your contractors. They want your tax returns, financial statements, all of it. So don't think I'm under 75, I'm totally fine. You might pay Christmas bonuses to everyone. Mark my words, February, there'll be a heap of people getting these letters. I reckon they've got a software in there and it's just automatically sending them out. And their reviews take time. So make sure if you haven't already, get audit insurance. But they're getting all of this data. The wage components, and again, as I said about the contractors, they're really going after that one and getting the detail. Not declaring fringe benefits and adding that into your base as well. And then the other one is grouping purposes, where you might have 2 or 3 entities and you might even be in business with someone else. You're a director of one company in business with someone else, and you've got other entities that you're the director of, and that one's not registered for payroll tax because it's got next to no people in there, only a few, and your other businesses have. They're trying to group everything together and make that one liable as well. So I've seen that coming out through. Not declaring interstate wages because they're sharing and caring with all of their other state revenue officers as well. Not including director superannuation. They're picking that one up from the tax returns as well. And some people are just putting in the regional rate. I don't know why they're getting that wrong. And then the agency labour hire. Because what happens with these agency labour hire, those companies, they're lodging their tax returns and they're saying, oh yeah, we're not liable for payroll tax on these employees, we're exempt because of XYZ. And so the State Revenue Office gets those details and then they look and go, okay, well, let's look at the people that are employing those people, and hence you get your letter. So the process involves a letter and a phone call from the SRO. They'll often send the letter to us. They'll often phone you just to freak you out, I think, because every time the client calls us and they're like, oh my God, the State Revenue Office called me and this is what they're doing. They usually go back 3 years worth of data. When we go through the process, I like to give them all the information, get it right, spell it out really simple for them so that we can just kind of get it all. If we need a recalc, if we find something, maybe you had something that you said it was a contractor, we quiz you on all your contractors, send it in, and then hopefully we get a green tick and we move on from that. But payroll tax is something really to be focused on because they are just getting very aggressive at the moment on that. So that's kind of getting through all of my slides. Finally, I did get through even with the cold. Is there any other questions that anyone maybe had? Just looking at, I don't know if I addressed this. Someone asked, how do I know when I register? I think maybe that question came up before I was then touching on that topic, but just in case. So registering, I would check every time you lodge your IAS, so your instalment activity statement, your total wages, total super, is that over 75? That gives you that overall, or look year to date of your overall payroll, where your payroll, and see, and also think about your contractors. because that's the hidden sleeper that I think is there that many people are not aware of, and have that quiz of contractors. To be really thorough on the contractors, I always recommend that you would actually have 2 contractors accounts in your Xero file. One, contractors with super, and I call it that, contractors with super, so that you don't miss it. They're the ones that you want to do super. Most likely they're with your work cover, they're with your payroll tax, and then contractors with GST, or not GST if they're not registered. But I would try and do that to look at that as well. There's a question about, can an email be a confirmation with a contractor? An email will be part of, I guess you could nearly say, the business case of putting together, are they a contractor? If they're an employee, fine, you're paying all of these taxes and off you go. But if they're a contractor, an email would be what I would say to be part of what you're trying to put together. Yeah, and then just a question on the working holiday. Yeah, so the working holiday, the registration, easiest thing, and we can put a link up here, but easiest thing is if you Google ATO, working holiday maker, employer registration, you can just click on that, and it literally just says what's your ABN, you're employing, how many people, and that's all they really want to know. And I think that's going to be a data match thing on the ATO side, if they do something with it to link in, because when you're doing that and you put that into your Xero file, you're actually doing that at a different tax rate. So they're getting 15 cents in the dollar, whereas if they're a foreign resident, which is what they'd be otherwise, they're actually having 32.5 cents in the dollar from Xero. And if they're an Australian tax resident, they're 0%, because the first 18,200. So that's where that's important to have a look at. So coming up, hopefully my voice will be way back on track again. I just can't believe it's still lingering like this. So next week is definitely going to be the week not to miss. Many of you would have seen our smart cars buzzing around, and everyone always says to me, why do you have, cars with smart on it? And why do you do that with employees? When you see the numbers, and even more so with the EVs, OMG, the EVs, the pre-tax benefit that it is to the employee is a no-brainer. I don't understand why more small businesses are not doing this for their employees. Not to mention they've sold their car, and now you've now given them a car. Makes it harder for them to leave. Don't tell all of my people that, but makes it kind of a little more stickier. But it's really, really good from a win-win on both perspectives. So I'm going to go through some numbers on that to give you an idea. Petrol cars still work out really good, but the EVs, I'll save all of that for the next one, but that is absolute gold. But lots of people ask me, wow, you guys must be doing really well. You're buying all of these cars for your team. Yeah, it's called a win-win for both of us. A 1 + 1 = 3. So I'll explain all of that to you. Then we're going to talk about super guarantee, employee terminations, and I've bumped another few others, maternity leave and a few others into that one as well. I'll update that. And then in the last one, I've got the legal landscape, where I'm going to have a lawyer joining us as well. So anything else that you want to get up to date with, just like and subscribe to our YouTube channel. We always record all of these webinars. If there's topics you'd like us to cover, my goal on this employee series is trying to cover everything there is to being a small business employer, because I just find a lot of the information is spread everywhere, and it's just getting harder and harder for us all. I've got 20-something employees, and it's just amazing how much harder it is. They should be making it easier for us. So if there's anything else you would like me to cover, do let us know, and I can see if I can squeeze that in on one of the sessions as well. And check out also our website, the Employer Hub. We've tried to put links to everything in there so you can kind of go into one spot. After today, I'll probably put a few more links in the working holiday thing and a few things like that. But thanks very much for joining us. Thanks for putting up for my coughing attacks, but I made it to the end. And I'll see you all at our next one. But next one's going to be the greatest one, and you'll be looking, and I bet you there'll be lots of company cars coming out of it as well, because so many even of my other peers, my other accountants, why do you do that? And then when I show them the numbers, they're like, oh my God, I had no idea. So maybe a few accountants will be joining the session as well. Anyway, thanks very much everyone for joining, and I'll catch up with you next week. Thank you.